stock valuation. For this particular topic, we want to discuss the concepts, the background, the foundation, if you will, of finding the value of common stocks. Now, as a little bit of a disclosure, if you will, these techniques utilize all sorts of different types of data. So what I want you to keep in mind is that we are not doing the research to find the values or come to a value that we could rely on, if you will, as the real number or as a predicted number. So I guess what I'm trying to say is don't use these concepts on your own stocks. The values, the research is not there. We're not doing the due diligence that financial institutions would do to come up with values that estimate and predict values in the future. So let's start talking about just a one-year investor. If you were going to buy a stock today for P0, and then at the end of the year you expected to get a certain price and then a dividend within that year, we would like to be able to calculate, at least for this particular investment, R sub E, which is the equity cost of capital. Now, if we do a little algebra on R sub E, we could come up with a couple of formulas here, right? And one of the formulas, after we expand a little bit, talks about two components. Part of the return that you get when you buy a stock comes from dividends, and part of it comes from the capital gains rate. Now, where do the capital gains rates come from? How do you determine what they are? Well, in reality, if you're using real data, it's just the return you receive minus the dividend yield. But in reality, if you look at the theory, what represents this capital gain? So we'll talk about that as we go on a little bit. So again, the expected return you get from stock, I think shouldn't be a surprise to anybody, comes from dividends, and it comes from capital gain appreciation. So one of the formulas that we can use, or one of the techniques we can use, is something called the dividend discount model. And for this model, we want to look at dividends, obviously, and to find the value of a stock, P0, you need to know the dividends in the future, and you need to find their present value. Very similar to like you did with a bond, we also need to know what is this future value out here where we could either sell the stock or the stock could be repurchased. What would that value be? Now, the challenge with this is there's a lot of predictions going on here. There's a lot of information that we really just don't know. For instance, what value would you give P in the future? Right? When would you sell this stock? Not just when the price goes up, but what I'm talking about here is what actual day would you sell it? What price would you be able to sell it for? We obviously don't know this number. So the dividend discount model has a couple of important assumptions. One, it assumes an infinite holding period for the stock. Having said that, the price of, or the present value of any stock at infinity is zero. Assuming also a constant growth in dividends, we end up with this formula here where we just find the present value of all dividends to infinity. Of course, that's very difficult to do, but the basic formula is we need to understand what is this value, or what are these dividends going to be moving forward. This assumption of constant growth allows us, again, to do a little bit of algebra, and we simplify this formula. the value of a stock equals next year's dividend divided by the cost of equity minus G. Expand that a little bit. Since we don't know D1, what we do know from our assumptions is we have assumed we know what the growth rate of dividends is. So D0 times 1 plus the growth rate divided by, again, cost of equity minus G. Again, if we simplify this formula, this is what we get. We get that the cost of equity, right, equals dividend growth plus some value called G. And again, this formula is algebraically equivalent to the formula from the previous slide. So the value of a company's stock is dependent on the current dividend, the cost of equity, and the growth rate. And again, what we want to talk about is growth rate. When we talk about growth rate, what are we talking about? What is that variable specifically? The growth rate that we're looking for is the growth rate of future dividends, because our formula before here inquires or has all of these dividends into the future. So that's the growth rate that we're interested in. So what if we have a constant growth model? This comes from the stock valuation worksheet. Stock valuation, I think it says dividend growth might be the exact description of that spreadsheet. But here we just plug in the information we know. Recently paid a $3 dividend. That goes in the box for D sub 0. The required return on this stock, the cost of equity is 16%. The growth rate of historic growth rates of dividends have been 7%. So the value of this stock is $35.67. So what would you do if this stock cost $37? Would you pay $37 to get something worth $35? And in fact, if you did pay $37, you would expect to earn 15.6% return when you wanted 16% return. So again, this is just a basic model. We haven't added any of the curveballs that we'll add to this conversation, but that's the basic model. It's a very simple model. The next things we want to talk about, though, is we want to talk about how do we find these variables. So the first variable we want to talk about is this variable G. And G represents the future the future growth rate of dividends. So the dividend payout ratio, something we know of obviously, is just the percentage of earnings that are paid out to shareholders. If you assume that the number of shares outstanding is constant, right, the company can only do two things to increase its dividends. It either has to increase earnings or it has to increase the dividend payout rate, the percentage that's paid out. So let's look at an example of how we might do this. This is using something referred to as the retention rate. So how do the earnings of the companies change? Well, if we assume that the earnings of the company as it stands today is fixed, it doesn't change, the only way earnings can increase is if you have new investment. And of course, the new investment has a rate of return. So that's the increase in earnings to the company. So the earnings of the company times the retention rate basically gives us an idea here of what is it that the company is keeping? How much money is retained in dollars? So if you take the retention rate, that's the fraction of earnings that are retained, right? It's 1 minus the dividend payout ratio. If you multiply the retention rate times the return on new investment, this will give you a growth rate of earnings projected for the future. If the company keeps this retention rate constant, then the growth rate in dividends will equal the growth rate in earnings. So there is a potential connection between profits, the earnings of the company, and dividends and their growth, but it has some assumptions. Number one is that we don't change the rate of retention or the rate of payout, if you will. So if a company wants to increase its share price, should it cut its dividend and invest more, or should it cut investment and increase its dividends? And again, this is a fairly simple question on the surface, but we have to add some assumptions. So we have to add some concepts that will provide some evidence of what the answer really should be. So the answer here really depends on profitability of projects, right? Cutting the firm's dividend to increase investment will raise the stock price if and only if new investments have a positive net present value. And that's a fairly straightforward answer. It makes some sense, right? If you can increase the value of the company through net present value, as we'll talk about in some later chapters, where the money comes from should not affect the change in value of the company. Sorry about that. Something happened to my PowerPoint. Sorry. So, one caveat that I have here is that we have to keep in mind that this is true if and only if there's some information describing why we're doing this, right? If investors don't know why you're reducing the dividend, they will assume the worst, not the best. We can also use G for growth using the time, this is using that retention model using information from the Disney company. So the Disney company has a current retention ratio of 75%, which means obviously their payout ratio is 25%. The dividend payout ratio is the number you find in publications. The return on equity, again, found from publications, says that, look, when Disney does things, they typically return a 19.5% return to their shareholders. So what is the growth rate? The growth rate using this retention model is 14.57%. Now let's think about this just for a second before we move on. Is it likely that Disney can increase its dividends every year to infinity at a 14.57% growth rate? And I would like to, my opinion is that it's going to be very difficult to maintain that type of growth over the long haul. Maybe a year or two, but not forever. We could also use the time value of money to solve for the growth rate. So what we're going to do is we're going to calculate historical growth rates, and then we'll ask more questions about that. So we can go to Disney and we can find their historical dividends, right? In the very beginning, 5 years ago, the dividend was 80.8284 cents. Now it's $2.86 4 years later. So you plug those numbers into the dividend time value section. It's 4 years of growth. That takes 36.31%. Now again, if 14% was a challenge, 36% is even a greater challenge. So now we have to think about what growth rate do we really want to use. what makes sense for Disney? 14.5% growth rate to infinity is probably unreasonable. If you look at the data that we've gathered from Disney, right, we know about their payout ratio, here are their dividends. This is all the information I know about the Disney company and the dividend discount model, then we can plug that into our equation. The problem is using the 14.96% growth rate creates a stock value that is negative, right? We can't have a negative price, so this really doesn't make sense. And again, using this growth rate really doesn't make much sense at all. So we probably would want to adjust our discount rate so that or a growth rate, so that it's a more reasonable kind of a number. I mean, typically companies are going to try to use some type of sustainable growth rate. At the very minimum, they're going to try to keep up with inflation, right? So a number closer to 4, 5, or 6% is probably more realistic. But for right now, we just need to recognize that based on the data we have, the dividend discount model isn't going to work very well for Disney. One of the things we can get from this model, though, is we know that the discount rate, this growth rate changes from time to time, right? We need to realize that this is an important aspect of this model. When you change the growth rate, since in reality that's the thing that's going to change the most frequently, then we have to then realize that there could be some massive swings in value when the company's economics changes, when their returns to investors change. That can change the value. So we have to be aware of and concerned that that we understand the implications of changing the values. So that's we'll come back to another video. Part 2 will follow this one.